Hey, welcome to the Market of the Moment update for the week of June 13th, 2022. Michael Oldham and Chris Madrid with you
What is
here.
up?
What's up?
And this
Crazy
year
news.
is flying by for sure.
2022 is flying by very quickly. Maybe it's trends and numbers for the last week. So getting into Collin County here, we're looking at 8% over list price when you go to buy that home. That is the same as last week. Last week it had dropped about a half a point, and the week before that it had dropped half a point. So basically you're down from 9% in the last couple of weeks down to 8%. 5 days on market, there's still a 1.3 month supply. And this week I've added something new. We're going to start kind of tracking that's new listings compared to what's sold. I think that gives a pretty good indication of what's going to happen or what's happening with the market as far as inventory. So when Chris and I started this back in August, September of 2021, I believe we're coming up on a year of this.
Nice.
You know, these new listings, if we saw 566 new listings, there would have been 1,200 sold, most likely 8 months ago. The new listings coming on was half of what was being sold. Thus, we're in the inventory situation we are in now. We've been talking about the last couple of weeks. We've been getting a lot of emails, a lot of texts, a lot of phone calls from builders. They're getting more inventory on the ground. So we've been expecting these month supply to start ticking up this week. They actually ticked down a little bit in Denton County, ticked down, up 1/10 of a point to 1.2 month supply, 5 days on market. And in Denton County, you're at 106.7, which I believe is, I can't see that. I believe it is down 1. Can you see it?
Denton County?
Oh, and then the new listings in Denton County was 569 versus 320 being sold. So that number definitely, that's almost mirrors Collin County, pretty close. Down to Dallas County, 105.2% of lists. That's the same as well. So we've been hearing a lot about, the market ticking down and all of these things. I made a comment yesterday on somebody's post that, just because realtors and mortgage folks are speaking of the market and prices reducing, they're not reducing from the list price. They're only reducing from 8 to 9% over ask.
Right.
So, you're still paying over list price. It's still a good time to sell, just as it's a great time to be buying. It's just a good market right now.
Yeah.
So,
hey, on that note, right? So people that are uninformed, so the customer that is like, hey, I'm gonna wait because housing is gonna plummet. They're gonna end up paying more next year, right? Because again, they're all they're hearing. So like again, this is talking about fascinating information. The information that came out today: weak housing data confirmed fears that the economy is faltering as housing starts dropped by a massive 14.4% month over month in May. Building permits also fell to 169,000 from 181,000. They're essentially down 7%. Jobless claims also showed weakness by 229,000 new jobless claims versus an expected 217, right? So again, if you take that at face value, you're going to think the sky's falling.
yes.
But again, it's important to know and work with professionals that know when the best times are to obviously capitalize. I did find, and I'm going to send this to you just for after the fact so you can look at it. It is super fascinating to see how the federal funds rate has gone up in recession. Federal funds rate comes down. Federal funds rate goes up. Recession comes down. Federal funds rate goes up since 1954. That's been tracked. Yeah. It's just fascinating to see how that works.
So
it's exactly what we're talking about here.
How we add it to our presentation. So Grayson County, this is our county where you can still buy just over asking. It's at 0.1%. That is actually down 1 percentage point We were at 101.1 last week. 12 days on market. Once again, we've talked about you get a little longer days on market in these rural areas. Could be inspections, appraisals, more due diligence to be done on land and properties that are selling in Grayson and Parker County. And then here you have a 2-month supply, and that actually ticked down. It was 2.1 last week. So actually Grayson County supply is coming down. So it would make me start thinking that the sales price to list price might tick back up again next week. So
Yeah.
in Grayson County, you had 91 new listings and 52 sold. And that kind of stuck out to me just to see the difference in the markets of Grayson County to Collin County and Denton, where you've got, 600 to 700 homes a month being listed to under 100 in all of Grayson County. So it shows you that population different. All right, jumping over to our west, to Tarrant County, the home of Fort Worth, 104.4% list price to sales price. That remained the same from last week. 6 days on market, also remaining the same. Inventory in Tarrant County actually went down 1/10 of a month to a 1-month supply. New listings there, 807 and 546 sold. So once again, you're seeing the trend of more homes coming on than are being sold in that's like a 7-day picture. Parker County, our rural county in the west, much like Grayson County, 101%. That remained the same, 12 days on market for the same reason. It's a rural county, and they have a 1.9-month supply, which remained the same. 121 new listings versus 49 sold. So that tells me Parker County is going to get tighter and tighter, actually. So Rockwall County market, 103.6%, 3.6% over list. That took 0.2 percentage point. 7 days on market, 1.7-month supply remain the same. Here your listings to sold a little more balanced out, but still more listings coming on than was sold. So
last week we saw, so early last week, we saw rates in the 5.5 to 5.8 range, right? Is kind of where they were at. A lot of key inflation information came out on Friday. CPI came out, which is the Consumer Price Index, and sent the world, good Lord, in a tizzy. So, I mean, we saw, sell off in, mortgage-backed securities. So I guess that here's the biggest difference between the stock market, which is short-term, right? And then you have bonds or mortgage-backed securities, which is more long-term, right? So anytime there is good or bad information, that's going to either help or hurt one of the markets. Well, because inflation's such a or like, I think right now we're hinging on like hyperinflation, right? Which is where it's just everything just costs too much. You can't afford to go out to eat. You can't afford to put gas in your car. You can't afford to buy groceries. Like that's hyperinflation, and we're on the heels of that unless the Fed steps in and kind of pulls the reins back, right? So as of Friday, a lot of key information came out. Causing mortgage rates to tick up significantly on Friday. That didn't slow down on Monday. It didn't slow down on Tuesday. And then yesterday, of course, there was a little bit of information that had come out indicating that the Fed was going to increase the federal funds rate by 75 basis points instead of 50, right? So for the last month, we knew they were going up at least 50. But there was a leak or something that came out that, you know, kind of gave the markets an idea that the Fed could be going up 75 basis points, which means that they're, you know, that they're taking it a little bit more seriously, right? As far as taking inflation more seriously, wanting to really, you know, try to pull back on that. So, so these are the charts, right? This is a mortgage-backed securities chart. Again, we've touched on, we are definitely in a downward trend on mortgage-backed securities, and we've clearly seen from, you know, from March and April of this year, when mortgage-backed securities were at their highest point, rates were at their lowest point of the year, right? So now that we've seen mortgage-backed securities drop to their lowest points, which we're seeing June, right? This little ticker on the bottom right says June, and then if we're moving from that date, that June 1st date to now, I mean, we can, you know, clearly see the activity, the significant activity just in the last, you know, 15, 16 days. So that's what this is showing is, again, we're still in a downward trend, which means that, you know, rates are still going to continue to rise. But, and thankfully enough, yesterday we had a little bit of a reprieve. So we did get, so some of the losses that we suffered Friday, Monday, and Tuesday, we got a little bit of that back yesterday. So when that happens, right, when we're watching the mortgage markets and specifically rates and these, you know, these key indexes, on days like yesterday, and then even today, we definitely got some back today. We're saying, hey, we need to lock, especially if you're closing the next 2 to 4 weeks, right? And if you're looking to purchase in the next 2 to 3 to 4 months, it still may be a good time to, you know, explore locking, especially because we, again, from what we can tell, rates are going to continue to rise through the rest of the year. Now, we hear the Fed talking about, you know, they're going to continue to increase their key rate, which is the federal funds rate that we talked about from yesterday. That doesn't necessarily impact mortgage rates, right? But it does, as inflation, if inflation doesn't slow down, right, then we're, you know, we'll definitely continue to see mortgage rates move on up. So looking at the charts, talking about mortgage-backed securities, a mortgage-backed security or MBS is an investment similar to a bond that is made up of a bundle of home loans bought from banks that issued them. So where you can go on a Fidelity or a Schwab or, you know, Robinhood or whatever you want to buy, and you can purchase a stock or a portion of a stock, right? Or crypto or whatever it is. Mortgage-backed securities are similar to where, you know, like from guaranteed rates perspective, we're going to originate, you know, $1 billion in loans that'll get bundled for the month or for a couple week period, and then it gets sold off in the secondary market. So that's essentially what mortgage-backed securities are. Is it's a bundle of home loans that were essentially purchased and then sold off in the secondary market. So so talking about, you know, mortgage-backed securities, it typically mortgage-backed securities and bonds work similarly, where like the stock market, obviously it's just a little bit of a difference there, again, short-term and long-term investments. So so in a nutshell, that's kind of what we're looking at here on the charts, and obviously the just the really in the last 2 or 3 months, just the quick the quick acceleration upward of mortgage rates, and then obviously, you know, mortgage-backed securities dropping significantly. So what you got? I see you talking, but you're on mute. You gotta take your mute off. Oh, dang, mute. There you go. Say it again.
My question was going to be, if we want to see interest rates back in the low 4s, where is this chart going to have to be?
Back in the 105, 104 to 105 range. Okay. And as of now, right, because we can watch this by the minute. So right now we are at 99.25. I think this was from yesterday. So as of close yesterday, we were at 101.03, right? And we are currently sitting at 99.25. So we've got, I mean, yeah, there's a lot of.
To get to 104 and 105, what has to happen in the economy, do you believe?
Well, I mean, again, the Fed is going to continue to hike the key interest rate, the federal funds rate, right? They're talking about the federal funds rate being 3.5% to 4% by the end of the year. So it won't be immediate, right? It's going to essentially, the Fed is going to put the U.S. economy into recession. They have to, in order to slow, in order to slow things down. But like the crazy thing is, I was talking to another title partner buddy of mine, and this has happened before, right? We were looking at charts over the last 50 years, and we can see, man, if I would have thought about it, I would have said that one to you too. It is super fascinating to see the correlation between when the Fed spikes the federal funds rate, and there's a period of time that passes, and then immediately we can clock the recession that happens afterwards. And again, it's happened like, hold on, I'm going to pull it up because it was super fascinating yesterday, when we were looking at when we were kind of looking and comparing that data to, essentially, it's almost like, we learn from history, right? A lot of things that
You should.
we should, exactly right. We should learn from history, and our Fed has not, because essentially what they're doing now has happened 10 times before, and it causes the same thing, right? So inflation starts to peak, they will bump up, accelerate the federal funds rate, and move it up as quickly as possible. That causes the economy to slow down significantly, puts us in a recession, and then mortgage rates drop, right? So then things become a little bit more affordable. Customers are able to, or homeowners are able to then refinance, free up some cash flow. Spending starts to take up again. And now this doesn't happen overnight, right? It doesn't happen over a period of time. We've just been in the environment where it's like inflation. We've been talking about inflation since 2000. Things have accelerated a lot quicker, I guess.
When might we see 4% again, based on your research from yesterday and the past 10 times? And when might you predict that we could see 4% again?
Man, such a,
I know it's
no guaranteed, 12 to 18 months.
Obviously, so 18 months to even possibly get back down to the fours.
Yeah, 12 to 18 months. Yeah, like again, some of the conversations I've been having here recently is, if we're looking, so you and I have talked before, 5, 10, 15, 20 years out, right? Let's just look at 5 years from now to the next 5 years. If you're looking at purchasing a home between now and the next 5 years, right now is the best time to buy. Yes, interest rates are higher, right? But they're only going to continue to go up, and home prices, you're going to go, like we've talked before, right? This isn't like new. You're going to go back to normal appreciation, which is 5 to 7% a year.
Yeah, we're getting ready to talk about that. So, all right. Well, we usually hear the bottoms dropping out, or home prices are falling, and things of this nature. But the truth is, home pricing is decelerating. And when you decelerate, often your foot is still on the gas. It's just not on the gas as hard as it was before. Right. So you can slow down and decelerate with your foot still on the gas. And, that's what I feel like the market is kind of in right now. We are slowing down, but our foot is still on the gas to some degree. So I want to just, talk real quick. Home price deceleration does not equal home price depreciation. Because you hear the market is slowing down and things of that nature, please don't think that all of a sudden your $500,000 house is only worth $450, because that is not the definition of deceleration. Deceleration is when home prices appreciate at a more moderate pace. And the last 3 years, we haven't accelerated at a moderate pace, or appreciated at a moderate pace. We've appreciated at an ungodly pedal metal pace. And we should be very happy with that, but you can't expect those things to happen forever. So Depreciation would be when your home value decreases. And that's going to be the situation where all of a sudden there are way more homes on the market than there are buyers for those.
Right.
And
Well,
that
and
is
real quick,
the situation.
no.
We've
What's
been
what's a stabilized market again? 6 months?
supply, and we don't have anything even at 2, I don't believe. So,
No.
uh, Parker County's at 1.1, Rockwell's at 1.7. Those are rural counties. Grayson has a 2-month supply. And everything else is in a 1 month, under a month and a half. So we are a long way from a balanced market to where you're going to actually see depreciation. As Chris and I have talked, the next 5 years, they were expecting, maybe 12 to 15% in our Dallas market for this year. And then we're going to get down to 8, 7, 8%, and eventually probably settle in at 5 to 6% year over year, price appreciation. So no, that $500,000 house you bought last summer is worth more today than what you bought it for, even with deceleration.
Absolutely.
Just means that people selling their houses are not getting 10% or 20% over asking now. They're only getting 8% over. So just like to set the record straight on that piece. As we talk, there's a ton of real estate news always floating around out there. You can get it anywhere you want. Facebook can be your news if you want, but that doesn't make it right. So get with people you trust. Hopefully that's Chris Madrid, Michael, and Amy Oldham. Give us a shout. We love to educate people on what the market's doing. That's our job.
Yeah, absolutely. Yeah. And again, a lot of what I'm doing right now is, we're evaluating, hey, what does it look like to buy versus rent, right? So those are a lot of the conversations that we're having right now. So yeah, give us a call. We're happy to talk through all those numbers with you.